traders here. This is Chris Capri with SecondSkiesForex.com. So doing a new video in the Ichimoku series here. So I've done a video on the Ichimoku time or number theory, and if you all remember from that, Ichimoku time or time is pretty much what the underlying pillar or the main underlying pillar of Ichimoku theory. But there are really three pillars if you look at it as a whole. And that's time theory or number theory, there's wave theory, and there's price theory. And so this is the second component of that. So we're getting into Ichimoku wave theory. And so let's dive into it. Just some basics about it that, kind of like in the number theory, we're not looking for exact fixed hard rules. We have to have a little bit of flexibility. There is going to be some discretion in this. The main thing is that you kind of get good at the skill of it and the basics of it. We're going to go over the basic components today and talk about how you can understand wave theory, how you can use it for your trading, and how you can combine it. Well, once we get into it, then you'll start to see ideas of how you can combine it. But first, we're going to get into the basics of wave theory, spend some time just practicing the basic components of it, and then we'll start getting into later on, after you've had some experience with it, counting waves, working with waves, detecting waves, understanding how they work together. Then we'll start working on combining them. So let's go ahead and get into this here. The basics of the theory is there are three basic waves. There are I waves, V waves, and N waves, and I'll show you the visuals of them. But they work with price and time, particularly more with price than they do with time. So in other words, waves tend to work better with price. That's a much more advanced thing. First, you need to get comfortable with just basic wave theory, get used to it, combining with time, and then we'll start working on combining with price. There are also two main types of mid waves as well. There are Y waves and P waves, and we're going to explain the basics of that. So basic waves, I wave is just a single leg. And so it could be an up leg, a down leg, any one of these, down leg here, an up leg. They can be impulsive or they can be corrective. So it doesn't really matter what types. Usually if an I wave is standing on its own, it's usually more impulsive, but also the corrective portions of legs can also be I waves. A V wave is usually an up and a down leg or a down and up leg, and it's usually impulsive corrective, or impulsive corrective, or it could be impulsive, or it could be corrective, which is rare. Very rare that they're going to be corrective, impulsive. It's usually impulsive, corrective, up or down, down, up, or it's impulsive, impulsive. Very rarely is it corrective, corrective. It's a very rare thing. And so for those of you who have questions about my basic impulsive versus corrective, make sure you go to my website and check out my videos on impulsive versus corrective. I'll also put a link inside the forum to an article about impulsive versus corrective. But any of you that study my basic price action comments, you'll understand that those are some basic components of price action. An N wave is three legs. So you got 1, 2, 3, and it could be three legs down. It could be a down, up, down, or an up, down, up. So this is a basic N wave, and it's composed of three I, or it's also composed of two V's. So here's a V, or here's a V. So a V wave is composed of two I. So these are all the basic components or waves that you need to learn. It's simple 1, 2, and 3 legs. Now let's get into some examples of this. So these individual legs from A to B is an I. I'm going to mark the individual I ones here, A to B, B to C, C to D. All these letters from one to the next is a single I wave by themselves. But if we start to look in kind of a more macro structure, we can see a V wave here from A to B to C, or B to C to D, or C to D to E, or D to E to F. Those are simple V waves. Now, if you want to start looking for an N wave, we can do it by, say, B, C to D, or D, E to F. Sorry, D, E to F to G. So B, C, D, E, that's an N wave, boom, 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 boom. Or D, E, F, G. G, H, I, K, those are all N waves. And so you can start to see how they kind of combine together. But a basic note is that generally N waves as a whole, if the first leg is down, then the third leg should be down and it should be making a lower low as a whole. It doesn't always have to be, so this could technically be considered an N wave, A to B to C to D. But the fact that the D is not making a higher high than B means that the N wave structure is breaking down and the whole price action structure or wave structure is breaking down. We should expect a turn or reversal at this point. But here, B to C to D to E is very traditional structure. The first leg's down, second leg is a pullback, third leg is down and makes new lows. So we should be expecting a continuation of this here. In fact, we can also see, and this is very common, that inside of an N wave, like B to C to D to E, that the D leg can often represent a start of another N wave down, so D to E to F to G. So sometimes parts of N waves can be continuations of others, especially if the N wave structure is traditional. So for a traditional downward N wave structure, if we go back to the prior chart, a downward would be boom, 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 with this point making a lower low. A traditional up one would be boom, 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 boom. And with the end point being higher than this point right here. Well, if that holds, that's a traditional N wave, then the next leg should be a continuation of that. So we should expect continuations of that, which is good because this now starts to give us predictive qualities in terms of what we should be looking for in terms of the next price. That's the beauty of wave theory and time theory and price theory, which we haven't gone into yet. But if you remember from time theory, we can start to anticipate that based on the number of candles or the time that it's spent in that particular direction, we can start to anticipate turning points. It's the same with wave theory. And so if the structure holds, then we can expect continuation. But if the structure starts to break down, then we minimally can expect a corrective, contraction phase or a horizontal phase or a reversal at that point. Moving on to, let's see if there's anything else I want to cover in this here. I think that covers it. Just remember that V waves consist of two I waves. I wave is just a single leg, and V waves can be impulsive corrective or impulsive moves. But N waves as a whole, V waves, if we take this right here, are just ABC, and then N waves are just ABCD. Usually, so if you understand traditional waves, ABCD, that's an N wave basically. Is there anything else I want to say about that? I think that's it for right now. So, okay, that's the basics of the basic waves. I, V, and N waves. Some other notes about them. All of them basically form the components of each other. So an I will always be part of V. V will always be part of N. N's can also, legs of N waves can be part of other N waves. As I said before, I waves generally form impulsive legs, but they can be corrective. V waves usually have impulsive and a corrective leg to it. If it's impulsive, then we should start watching out for a possible structural wave change. N waves, as I said before, usually have two impulsive and one corrective. And the first leg of the N wave should be impulsive. And the first leg of an N wave is never corrective by itself. The first leg of an N wave is always pulsive. And as stated before, if an N wave should end greater than the first leg is up, then if the N wave ends greater and the first leg is up, then basically what we should be expecting is that the last leg of it should end higher. The same thing is that if the first leg is down, then if the N wave ends down, then the first leg of the next one we should be anticipating is down. So it's basically talking about the N wave continuation theory. Now the next one, let me show you, just go over that real briefly. So going back to this chart here, just to review, if a traditional N wave, which always starts with an impulsive move, if the first leg is down, the last leg should be down and it should be making lower lows. If that happens, then we should be expecting continuation. But if we see something like this, up, down, up, and this high at D is lower than B, then we should be expecting a new wave structure to be forming. But until that happens, then we want to be looking at, the wave structure continuing basically. See if there's anything else on this. I think that covers that there. Okay, midterm waves. So midterm waves, there are only two basic types. There are Y waves, which are expansion waves, and P wave, which are contraction waves. Y waves, generally the highs get bigger and the lows get smaller. So as the vibration, the highs get higher and the lows get lower as the vibration gets bigger. And what do I mean by that? The vibration gets bigger. It usually means an expansion in volatility. So there's a fight going on between bulls and bears. Both are trying to wrestle control, and so they're throwing in larger amounts of money, and so that generally means an increase in vibration. It's an expansionary type wave. These will often refer to accumulation cylinders, which is something that Jesse Livermore had talked about back in the day, and I'll show you an example of that. P waves are contractionary waves. They're like wedges, triangles, and pennants for those of you who know traditional price action structures. They generally break upward if the price action is more contracted above the middle line of that particular P wave, and they usually break downward if more of the price action is contracted below the middle line. If the price action is dancing right in the middle, then you need to wait and see and watch for a breakout. So let's go over some examples of that. Here's the basic structures of that. So this is a P wave contraction. So price enters it, and then the highs get lower and the lows get higher, or the highs remain the same and the lows get lower. So it's contractionary price action. You could also take this and reverse this to where the lows are getting lower, the lows are staying the same but the highs are getting lower. So just be a downward facing type wedge. So a pennant or triangle, these are P waves. These are contractions where things continue to contract, and that creates a tension or friction or a pressure for eventually a very large breakout. Usually for a Y wave, we're talking an expansion. So price enters it, it makes a lower low, then it makes a higher high, and a lower low even again, and a higher high. This is referred to, this was, as I was talking about, a Jesse Livermore accumulation cylinder. So this means that the market is accumulating. Generally, if the market was already in an uptrend and this is happening, that means the buyers are generally accumulating larger and larger amounts. There are still sellers present in the market, but the buyers are accumulating larger and larger amounts, and that's creating these bigger swings. And then the sellers are responding to that with more money. So we get this kind of expansion in volatility and expansionary type price action. And generally these are accumulations where more and more is being accumulated, and it usually leads to a breakout in the original direction as the market entered the whole Y wave. This would be another example of a Y wave expansion. So the lows remain the same but the highs get higher, or the highs can remain the same but the lows get lower. But the market overall is expanding in its overall structure. Let's take a look at a couple examples of that. So here's two examples actually of P waves embedded within each other. So we can see that the lows are staying the same but the highs are getting lower. And then on top of it, we're seeing another contractionary one inside of this here, where everything's getting more and more consolidated. So I'm expecting a massive break soon of volatility in gold. It could very well be, based on traditional Ichimoku wave theory, excuse me, taking a sip of tea there, that we have two contractionary waves happening here, P waves happening. On the larger structure, the downside, the sellers are winning. So if this larger structure holds, we should expect another break to the downside and then possible break further lower. But we have this microstructure where the bulls are winning more here. So the bulls are making higher lows while the bears are making lower highs, but the bulls are doing it more aggressively. So they're suggesting that this should be breaking out to the upside. So we've got two conflicting contractionary P waves here. This is going to create a lot of tension on the market, and when the market finally does break, I'm expecting it to be incredibly volatile. So it's very, very interesting to see this type of structure happening here. Now, in terms of the midpoint, if we were to draw an imaginary line in this bigger structure, we'd have to say, hey, where does the market, like for example, if I was to draw, imagine just an imaginary line right down the middle of this here. Now, where is more of the price action, imagining this line here? More of the price action is spending more time in the upper bandwidth of this lower line, right down the middle, which means that we should be expecting from a P wave or from an Ichimoku wave theory structure that this P wave contraction, since it has more of the price action in the upper half of this, we should be expecting a break to the upside. So that's how you use that basically. Some examples of a Y wave. This is a very good example of a Y wave on the Aussie dollar, that we had an uptrend to begin with, then the market went into a expansionary Y wave. The highs were maintaining the same, but the lows kept getting lower and lower. Now, from a traditional price action perspective, highs are maintaining the same, lows are getting lower and lower. You would think the sellers are winning in this case, but what's really happening is that, okay, the buyers had a very strong trend. They had to take some profits. They had to, sell to take some profits. In that process, sellers started to come in larger and larger amounts, but the buyers were just happier to accumulate at lower levels because they say, hey, if we believe the uptrend is going to happen, we'll be happy to buy it at lower points, because when this thing does break up to the upside, we're just going to get more and more profit. We're buying it on the cheap, buying it on the cheap, buying it on the cheap. And this is an accumulation type process. They're buying, and then when it does break out, it tends to be towards the same direction as the original direction that the market entered the Y wave. And that's what happened here. And this thing ended up going much higher. It ended up going to about 110 before it started pulling back. So this is a great example of a Y wave expansion. Okay, so now some basic notes about basic waves and N waves. I want to talk to you and show you how this structure can start being used to anticipate future movements. So we're just going to talk about basic waves here. So these are basic waves here. Each letter to letter is a wave. If we look at this here, we have an A to B to C to D. That's an N wave. The D point's higher than B, so we should be expecting that the market makes a new high. And that being the case, C to D to E to F is another N wave, and no surprise, it makes another high here. E is pretty much the same as C, but D is higher than B, so we should be expecting when this climbs up to break higher than D, and it does. Now this is where the wave structure starts to break down. All of these C, E, G, and I are relatively the same, but look what happens with H. H goes way lower than F. So we have a wave here, an N wave structure here, but if we look at this N wave structure, E to F to G to H is below F. That should be a big sign that the wave structure is now breaking down. We should not, if you ever have an E, F, G, H, a 4-point N wave, where the final leg of that N wave is lower than the first high, we should not be expecting a higher high at that point. In fact, if anything, you should be expecting the next wave down to make the same lows or lower lows than the prior point here. Now this makes the same low pretty much as this one here. So we need to say, okay, we need to watch for the next move and what happens. Well, J makes a lower low than H. So we have two lower lows or two lower highs, but all the lows are the same. So then we should be expecting a breakdown at this point. And that's what happens. We see two breakdowns of the N wave. And so that's what happens here. Then basically impulsive, corrective, impulsive leg down. Once we break below this point right here, we are no longer really looking for upward expansionary waves or N waves. We're only looking for sells really at that point. But as long as the structure maintains A, B, C, D, D is higher than B, then we should be looking for more highs above D, as long as we don't break below C. If we were to break below C and close below C, then we would start looking at a weakening of a structure. But that's not what we see here. So here we go, A, B, C, D. The pullback to E, fine, is where C is. We should be expecting the next leg up to go higher than D. And it does. The pullback goes to basically the same level, but look what happens at H. It's weaker than F. Once that happens, we see a wave structure failure at this point. So we should be expecting minimal pullback to G, likely lower, but if G holds at I, then we should be expecting again a lower high than H. And so now we're starting to see a change in the wave structure. Instead of it being up, or up, down, or sorry, up, down, up, we should be looking for down, up, down. Hopefully that makes sense there. Now look at this right here. If you look at this here, J to K to L to M, simple N wave structure. Boom, boom, boom. That's it. Boom, boom, boom. 1, 2, 3, 4. Simple N wave structure. 4 legs, 3 major points. So hopefully that makes sense in terms of how, when wave structure starts to break down, that's when we start to look at and say, hold on a second, we can't expect continuations. We either expect sideways movement or we expect further breakdown, and then we look for change in direction at that point. Sorry, taking another sip of tea. Is there anything else I want to say about this here? Yeah, as a whole, when looking at waves, you want to look at micro and macro structure. It's better to kind of look at it more from a macro point than it is from a micro point. We can, inside these little waves here, count other waves. Like we could go boom, boom, boom. So that is an N wave inside as a whole. But when you step back, it's really a V wave, or this by itself, F to G, is an I wave. So we can look at that. That's generally how you want to look at these. You want to look at it in more of a macro than micro, but you can look at it the micro. Just understand that you never want the micro to be the be-all, end-all. You want to look at more of the macro structure. So even though from F to G, even though it is an N-wave structure, boom, 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 it's also really an I wave. And that means from E to F to G is really a V wave. So hopefully that makes sense. Same thing here with G to H. It can be boom, boom, boom. That's an N wave. But if you look at it from a macro structure, it's really just one big I wave. So hopefully that makes sense as a whole. Okay, so now we're getting into, now that you've had some experience in this, I want to talk about wave counts. Generally, wave counts go in 3, 5, 7, or 9 waves. And usually once you start getting to 9, that's usually when the market is getting very, very close to reversal, if not a reversal. Very seldomly do things get beyond 9 waves. So we need to be looking at that as a whole. How do we start counting waves? Well, we kind of already know this. Let's just follow this down. So A to B is 1 wave, B to C is 2 waves, C to D is 3 waves. So we got 1, 2, 3 waves there. Okay, so let's count this. 1, 2, 3, 4, 5, 6, 7, 8, 9. So at this point we should start be saying, hold on a second here. This is getting very, very long and extended. Usually the market starts to reverse around 9 waves. We have one more point, 10 and 11. Very, very long. Most legs and trends do not go that long as a whole. Usually there's a major pullback. And what do I mean by a major pullback? To where the market will take out one of the, if we're in a downtrend, the market will take out one of the highs of the prior pullback points. Now if you look, C is never breached, E is never breached, G is never breached, I is never breached, K is never breached. But once we start getting into deep territories, we should start looking for market structures to start breaking out one of these pullback points. Once it does, we're no longer looking for downward legs or looking for upward legs. And that's what happens. Look what happens here. M, now, okay, it doesn't break K, fine, but look what happens. N makes the same high as J. It doesn't make a new low. So we now have a structural breakdown on one of the micro waves. If the market pulls up from here and it breaks K's high, then really we're now in an upward N wave at that point. So we should be looking for pullbacks to continue to make new highs. And that's what happens here. Look what happens. Once O breaks K, the pullback to P is right where K's high is, and look what happens. Q makes a new high. So that's how you can start really understanding major structural changes. But take a look at this here. 1, 2, 3, 4, 5. Okay, it's 3, 5, 7, or 9. This one here is 1, 2, 3. Look at the same thing here. 1, 2, 3. This is all just one big wave here, basically. Now take a look at this thing here. 1, 2, 3 waves. So we see continually that things continue to go in 3, 5, 7, 9. Very, very common. And that makes sense if you think about it from an impulsive and corrective perspective. Impulsive followed by corrective is usually followed by an impulsive move in the same direction as an original one there. So that continues until we see a counter-trend impulsive move. Well, if you think about it, impulsive, corrective, impulsive is 3 waves. Usually the market will end after an impulsive wave. Very rarely does the market end on a corrective wave. So if you think about it from a number standpoint in counting waves, that's usually how it works out. Take a look at this last leg here. 1, 2, 3, 4, 5, 6, 7, 8, 9. Boom. Market reverses. So that's the basics of counting waves. But usually at those points, 3, 5, 7, and 9, that's when you want to start looking for turning points, particularly in the later numbers, 7 and 9. Very rarely does it get beyond 9 waves. Very, very rare. It's possible at 3, but 3 could just be a normal N wave. And as long as the N wave structure is holding, if it's a downward N wave, that the last leg of the N wave is lower than the first low, well, then we should expect a continuation of the N wave structure. So at 3, 5, 7, and 9, that's where you generally want to start looking for, does the wave structure hold or does the wave structure start to break down? Once it starts to break down, then we're no longer looking for continuations. We're either looking for range-bound market or reversal at that point. But we need to see further evidence at that point. So hopefully that makes sense. Anything else about this? Wave counting as a whole, or waves as a whole, it's irrelevant of the time frame. However, I generally recommend using this on 4-hour dailies. When you start looking at weekly and monthlies, you can use that for predictive qualities. So generally, according to Ichimoku theory, when you look at weeklies and monthlies, you're using that to look at kind of a predictive, hey, okay, what's the current wave structure and how can I predict future moves from here? You can do the same with 4-hour and dailies. It's just that the predictive qualities won't last as long. But on weeklies and monthlies, that means it's going to happen weeks and months ahead, what we should be expecting of the wave structure, and therefore we can make a lot of trades on that. But 4 hours and dailies, particularly 4 hours, you're not going to get as much predictive qualities out of that. But bottom line is you can do wave counting theory on any time frame. Just understand that if you're doing it on a 1-minute chart, everything's going to be changing and in flux so fast it's going to be very, very hard. Even on a 5-minute, unless you've seen large moves on a 5-minute, it's going to be very hard to be counting and doing all that. So that's why I recommend really doing it on 4 hours and dailies. And then before the market opens, look at the weeklies or maybe the monthlies so you can start getting an overall picture of where future waves should be going at that point. But general practice, 4 hours and dailies. You can do it on any time frame though. All right, to review, there are 3 basic waves. These are the most important waves you could possibly work with. They're I, V, and N waves. Remember, all of those form components of all the other waves. An I is always a component of V. V is always a component of N. I's are components of N. And these 3 basic waves are the ones you're always counting. So you need the most experience with this. The next midterm waves are Y and P, expansion and contraction. Contractions are far more common. P waves are far more common than Y waves. Y waves are a lot less common, but when they do happen, it usually means accumulation. If we're talking that the market entered the Y wave on an uptrend, if the market entered the Y wave on a downtrend, then it usually means absorption, where the sellers are absorbing the buyers, and we should be expecting a continuation. If the end of an N gets high, so like for example, it starts off in A to B to C to D, where D is higher than B, that's a traditional N wave, we should expect it to lead to a continuation in that same direction. If an N wave starts off as a down wave, A to B to C to D, and the D point is lower than the B point, then we should expect it to lead to a continuation N wave in the same direction. Wave counting as a whole is 3, 5, 7, or 9 waves. Very rarely does the market go beyond this. Usually when it does, it's kind of in extreme territory, so watch out for this. And the last prior swing point of an N wave is what we marks the reversal point. So if you imagine an upward N wave, A, B, C, D, the C point is where we start looking at reversals. Once the market starts breaking below C, then we're really looking at reversal structures at this point, or breakdown of the N wave structure. If we're looking at a downward N wave structure, A, B, C, D, then the same thing. C is the pullback point, where if the market breaks above C, then we're looking for a reversal structure. We're looking for reversals at this point, and the wave count structure is broken down. So hopefully that makes sense. So that's pretty much it. It's a lot of material, and just keep in mind, this is just an introduction to wave theory. So there's a lot more components about this I would like to talk about, more advanced components, but it takes time to really learn this. I mean, months. It could take you months to learn wave theory as a whole. and so spend time just starting off with the basic wave components. Get those down. If you get those down, you can do, pretty much anything in wave theory. P waves and B wave or Y waves are more midterm waves. They tend to happen on larger structures. They can happen on microstructures, but they tend to be larger ones. So, understand how those tend to play out. But the key is learning the I, V, and N waves, wave counting, general wave structure, how to expect continuations, how to look for breakdowns and reversals. Those are all the keys to that there. So that's pretty much how that works. So I look forward to all kinds of questions on this, and I look forward to your continuous study of this, and this will probably, start sparking a whole new level of, study and practice and everything like that. Don't try and combine wave with time at this point. Try and use them individually. Once you get them down individually, then you can start working on combining the two. So hopefully that makes sense. Other than that, I bid you all adieu. I wish you guys good luck trading, and I look forward to your questions, and I'll see you guys on the forum.